Good morning, everybody. Lee Lowell here, smartoptionseller.com. Today is Saturday, July 18th, 2020. Welcome to another edition of the Saturday Synopsis. We like to take a look at the stock indexes, see how the markets fared over the last week, and provide some insight on what may happen in the upcoming week. We also like to provide some options information. We are options traders. I am an options trader, 30 years in the business, so I like to half of this little video, like to provide some options information, options strategies. People write into me and ask me some questions on making videos on some of these things. So I am here to provide that information for you. So let's go right to the charts, see what's happened over the last week. Expand this chart. We always look at the SPY, which is the barometer for the S&P 500 index, the overall market. The SPY is an exchange-traded fund that you can trade and tracks the S&P 500 itself. So what do we see over the last week? Well, once again, we've had a very, very small, tight range. These last 5 days right here, real tight. Summer trading is slow. Here's the blue line is the 20-day moving average. And we got, I think, let's see, what day was this? Last week, yeah, Monday was the 13th. So right in here, came down on the 14th, bounced right off the 20-day moving average. And then the last few days had this nice, tight little range here. As you can see, we're bumping up to some resistance. A while back, I had talked about this island reversal formation right here, which was a couple days worth of trading on a gap on the one side and a gap on the other side. Let me open up this chart a little bit so we can see it better. So these are gaps where there's just open space on either side. And when you have gaps on either side, it's called an island reversal. We had an island reversal to the downside. And what people like to see on the charts is that we like to see these gaps closed in the future trading, which is what happened here. So this first gap and the second gap were both closed, meaning the trading on following days traded above the gaps. So we closed all the gaps and the market looks ripe to keep going. We can draw a trend line here. Looks like we've got some here's the trend line right here. So we got some resistance coming up, bouncing off this. We want to try to get through the top here. This 1 day's worth of trading right here. That is the S&P 500's next resistance to get through. And once that happens, it will certainly try to take out the high back in February near 337 or so. So the S&P 500 looks like it wants to keep going. The next resistance is right here at this line around 323.5 or so. So the S&P 500, that's where its sights are set for next week. Let's take a look at the NASDAQ, which has always been the strongest of the three indexes we talk about. Still going strong this week. Let's see what day that was. Yeah, Monday made an all-time new high here. Then we had a little sell-off and it rallied back. So it's been pretty tight here. Okay, so at this point, the NASDAQ is just making new highs all the time. You have to go with what the market is telling you. Path of least resistance is higher. It's got the momentum behind it. It's still trading above all its moving averages. On the charts that I use, I got a 20-day, I got a 50-day, and a 200-day moving average. Those are the three that I track. You can see the NASDAQ has bounced each time off the 20-day moving average when it does pull back. So until it shows you otherwise, you have to think when we get a pullback, it most likely will bounce at least off the 20-day moving average at first. NASDAQ's been very strong. You got a handful of stocks that keep driving it higher. You got Microsoft and Apple and Amazon and Netflix. Although those stocks had a little bit of a down move this week, the NASDAQ is still powering higher. Path of least resistance continues to be up. Let's take a look at the Dow Industrials. We've been talking last few weeks. Dow was having a hard time getting through its 200-day moving average, this line right here. It kept bumping up against it and kept knocking it back down. But this past week, right here, this day right here, let me open this up a little bit. Right here, which was on Monday or Tuesday. Yeah, is this Tuesday or Monday? Both days. Monday and Tuesday, it popped above the 200-day moving average, finally stayed above it, and this is where we were for the rest of the week. Tight range towards the end of the week, but the big move was getting through the resistance at the 200-day moving average. It did it successfully, and now the path of least resistance should be higher. Looks like we got a little bull flag here. Bull flag is when you have, let me do a little line here. Bull flag is when you have a line here, okay, and then you have this little flag. That's typically a very bullish signal. Bull flag. The most likely path of least resistance is higher at this point. Okay, so the Dow Industrials finally broke out of its resistance, looking higher. S&P, NASDAQ, all looking higher. Let's take a look at the VIX. We always look at the VIX, which is an indicator of options prices in the market, as well as the fear gauge. When the market sells off, volatility rises. And when the market itself goes back up, volatility comes down. For people are less fearful as the market starts to go back up. 200-day moving average right here. We've been talking about the VIX. It had popped right off of the 200-day moving average and bounced up again. It ended yesterday, Friday, July 17th, finished below the 200-day moving average. In order for me to call this a defined new trend, we have to see it close below the 200-day moving average for a couple days. Yesterday was the first. And if it continues to come down, that means the market itself is going back up. So with the path of least resistance for all the indexes going higher, looks like the VIX will continue to go lower. That means volatility is going down. That means option prices themselves are getting cheaper. So if you are an option buyer, this is a good scenario for you because you like to buy cheaper options contracts. As option sellers like we are, and not so great. We like to sell options when volatility is high. We get more money in our pockets. But you know what? We take what the market shows us. So for now, once again, it looks like the markets want to keep going higher. Even though in the US here, coronavirus cases are ticking back up. We're setting new records every day, unfortunately, for people getting infected with coronavirus. We don't like to hear that. But, you know, in contrast to that, the market keeps going up. The market is a forward-looking mechanism. It is an optimistic-looking mechanism. The market sees good things ahead. And you don't want to argue with what the market is telling you, even though here in the U.S. things are not so great with the coronavirus. We are in the midst of Q2 earnings now. Q2 earnings really kicked off last week. We're having a slew of earnings coming out over the next few weeks. So we want to keep an eye on that. So far, things have been fine. You know, if earnings keep looking decent, then the market's just going to keep powering higher. So for now, stay with what the market is showing you. It's showing you wants to go higher. S&P 500, we have this little resistance here, but if it can pop through it, it's gonna take on trying to break, pass its all-time new highs in your 337. So path of least resistance is up. So continuing on, what do we want to do for the rest of this video? We're going to talk about options trading strategy. This week is the Strangle. The Strangle is an options trading strategy where you can actually take on a position in both directions. People have asked me a lot this week, Lee, with earnings coming around, how can I take advantage of a big market move in a stock, even if I don't know which direction the market, the stock may go after its earnings? I always say earnings are a crapshoot. You just never know which way the stock is going to go. It could have really good earnings and the stock drops, and it could have pretty dismal earnings, but for whatever reason, the stock will rally. So you never know which way the stock's going to go. And people want to know, can I take advantage of it moving in either direction? And you certainly can. A couple weeks ago, we talked about the straddle, but today we will talk about a strangle. Okay, let's say you're interested in Snapchat, and Snapchat has its earnings coming out on Tuesday. Now, just remember, this is not a recommendation. This is not advice. This is just for example purposes only. Let's just say Snapchat, you're interested in Snapchat, trading at $24.50. You think it's going to move this week. What can you do? And you want to buy a strangle, which is buying a put option and a call option for the same expiration date, but different strike prices. So how do you figure out which one you want to buy? Well, you look at Snapchat, and then what you can do is you can go to a website like, this is marketchameleon.com. Marketchameleon.com can give you history on a stock, and it can show you how far the stock has moved after earnings announcement. So if you go down to the historical earnings range, you can see the last number of earnings came out, and it'll tell you the implied straddle, which means the straddle tells you how much the market is expecting the stock to move during after the earnings are announced. So you can look back at these last few earnings announcements. Here are the dates over here. And the straddle is telling you what the market makers are thinking, how far Snapchat would move after earnings are announced. So here was almost 15%. It was expecting it to move, and it moved higher, 22%. Now this is telling you it can move higher or lower. It doesn't matter. It's just saying 14.9% either higher or lower. And it turned out to be it moved 22% higher because it's got a plus sign after earnings were announced. In this one, it was projecting a 16.2% move higher or lower. It dropped only 6%. Here it was 13.9%, and it went up 18.8%. Another 16% move. It only dropped 6%. And so you can see the numbers here. So what that's telling you is that Snapchat could move either greater or less than what the market is implying. So if you're looking for Snapchat and you want to buy Strangle, and right now, here's where it's telling you what's expected on its earnings on July 22nd, a 14.5% move higher or lower above its current stock price. Now, if you go back to the chart for Snapchat, 14.5% move is about $3.50 above and below its current price. So $3.50 above would be $28, and $3.50 below would be $21. So it's banking on Snapchat either going up to $28 a share or down to $21 a share. It can move in either direction. So that's a pretty wide move. If you look back at Snapchat's other earnings announcements, you can see these gaps here. What else? We got a gap here, a gap here. That's only moved about $2 or so. So do you think Snapchat can move $3.50 above or below? That's up to you. So how do you play it? Well, we can go to our Interactive Brokers option chain here. And if you look at Snapchat, and if you want to buy a Strangle, that means you're going to buy the put and the call. You want to choose the closest expiration date because the option prices will be cheapest on dollar-wise. So if you look at the 21 put is here is around 43 cents, and the 28 call is about 62 cents. You add that up, it's about $1.06. So you're going to pay $106 to see if Snapchat can move above or below 28 or 21. So if you add the $1.06 to each strike, now Snapchat actually has to go below $20 or above $29 in order just to break even on that trade. So you have to think, can Snapchat move above 29 or below 20 from its current price of $24.50, $24.67? I don't know, that's a pretty big move. So that's entirely up to you. So if you want to, if you're looking to buy a Strangle, which covers you on the upside and the downside, you really need to make sure that the stock could actually move that far just to break even. Looking back on the charts, Snapchat would have to move above 29 or below $20 just to break even if you're buying that Strangle. That's a pretty big move. Based on the past history, I don't see Snapchat really moving that far. So, that's up for you to decide. Another gap here. It's only $1 or $2. I don't think Snapchat can really move $4 just to break even. So that's just my take. Once again, so if you're looking to use a Strangle, you're buying a put and a call, same expiration, the closest expiration date before earnings come out, because that's the options are cheapest dollar-wise. So you want to focus on doing that. Not a real recommendation. So if you're looking to buy a Strangle, you buy before earnings, the day before, or the day of if it's announcing after the market close. And you want to make sure, look back at the history, use marketchameleon.com, go back in the history and the charts, see what the stock has done on earnings dates. If it hasn't moved that far, it's probably not a good bet that you don't want to buy the Strangle. So there you go. There's today's lesson on buying option Strangles. Once again, if you like this video, please give me a thumbs up on the YouTube, subscribe to the channel. Also, you can go back to our website, smartoptionseller.com. Put Selling Basics, click on this tab if you have not downloaded our free Put Selling Basics ebook. Also, Services tab. We've got our newsletters and our one-on-one coaching. Come visit us, send me an email. I love hearing from you. Have a great day, everybody. Have a great weekend, and have a great week next week. This is Lee Lowell signing off.